Ladies and gentlemen, a very warm welcome to you on this final show for 2025 as far as the Market Guru series is concerned, where you've always met the finest brains on Dalal Street. People and professionals who've navigated the markets with equal ease, be it a bull phase, a volatile phase, or a bear phase as it is going on now. In this series, we are now joined by Mr. Harsha Upadhyaya, CIO at Kotak Mahindra Asset Management Company. Mr. Upadhyaya is a veteran of Dalal Street and has spent now close to 3 decades with managing money. And he happens to be the final guest for 2025 on this wonderful series. Namaste Harsha ji and a very warm welcome. Here's wishing firstly a very warm New Year to you. Let's hope the final day of 2025 we continue to see the fireworks that are happening on Dalal Street today for rest of the calendar year that is to follow. Now, how does 2026 look to you in the crystal ball as far as equities are concerned?
Thank you, Shailendra, for having me on your show. And first of all, I would like to wish you as well as all your viewers a fantastic 2026. From a market perspective, we do expect 2026 to be better than 2025, as we have seen 2025 being quite volatile and range bound as well. That was due to certain factors such as elevated valuations to begin with. There was also a deceleration in terms of earnings growth that we saw during the year. We did have a kind of a reset in global trade and commerce, various other issues. So all in all, it has been a volatile 2025. And in that context, we believe that some of the negatives that we have seen during the year are kind of resolving at this point of time. As we look forward, we do expect earnings growth to inch towards double digits in the second half of this financial year. And going forward in 2027, we do expect it to go towards mid-teens. So that's a welcome positive change that we are seeing in terms of expectations. As far as the valuations are concerned, at least on the large cap segment, we can say that valuations are more or less around long-term averages. So that's also fine. So we do believe that 2026 is likely to be better than 2025.
Okay, that's at least a very modest and still a very hopeful expectation that we should have a better 2026. The Nifty on its own, ladies and gentlemen, is up about 10% in calendar 2025, but mid-cap and small-cap indices and except for sectors like metals, autos and to some extent commodities, most indices have had a terrible time in 2025. Mr. Upadhyaya, what stood out in 2025 was the faith that the retail investor continued to impose in asset management companies such as yours, funds on the equity side run by Kotak, as also in the broader market. What do you think were 2 or 3 reasons why this faith remained fairly strong, and how do you see the retail investor participation in the equity side for 2026?
Clearly, as income levels have increased, we have also seen increased awareness in terms of various asset classes, including equity. And those who have started to invest through SIPs, for example, have made it a habit to invest on a staggered, disciplined basis. And that's also one of the best ways to wade through the volatility that's there in the market, right? And especially in a volatile year like 2025, wherein you mentioned that Nifty is up about 10%. If you look at the broader end of the market, the broader end has really done much lesser than the indices themselves. And in fact, mid and small cap indices have done lower than large cap index like a Nifty. And within those indices also, the median fall has been higher for mid caps and small caps. So to that extent, those who tried doing it themselves through direct equity without a proper research and portfolio construction knowledge, etc., have seen their portfolio seeing quite a bit of erosion. And for them, going through mutual funds, especially through SIP route, has been a beneficial one. And that's where we think more and more people are actually embracing this new habit of SIPs.
Okay, fair point. The other thing, Mr. Upadhyaya, that happened in 2025 was the stellar returns that precious metals gave. I'm sure all the investors in SIPs offered by Kotak AMC in gold and silver have laughed all their way to the bank. But overall, as an equity market strategist, precious metals have spoilt the party for stock market pickers such as you. What is your prognosis for gold and silver in 2026?
We have always advocated to have asset allocation irrespective of what has been the past performance of various asset classes. Even if you look back and see what we had said for 2025, at the beginning of the year, we had clearly suggested that there has to be a reasonable allocation to all asset classes, not just go by past returns of equity, which at that point of time were very, very strong. And hence, there was a tendency to increase your equity allocation and rather ignore some of the other asset classes. But in fact, as Kotak Mutual Fund, we have always advocated, based on the risk profile, to have a reasonable asset allocation at every individual investor level. And that has clearly worked out, right? But as far as 2026 is concerned, after having seen such a sharp outperformance of gold and silver over other asset classes, it's very difficult to say that there will be similar performance in 2026.
Okay.
However, we still continue to remain quite positive on this precious metal rally even now. So we do believe that there is money to be made, but maybe the volatility will be higher given the fact that short-term performance has been such a strong performance, and at higher levels you are expected to see more volatility. But however, if you manage your asset allocation and if you wait through that volatility, you should still be making reasonable money even in gold and silver.
Okay, Harshji, we will very shortly in the next 1 week be wading through the quarterly earnings for the quarter gone by. How are you gearing yourself for this earnings season? One, will it be better than the second quarter that we've seen, where at least some green shoots were visible? And two, will it be better than the third quarter last year? What is the earnings growth on Nifty that you are assuming?
Yes, for both questions, I would say yes, we are likely to see better earnings on a sequential basis as well as on a year-on-year basis. If you look at first half of this year, we have seen Nifty growing at a meager 4% or so. Mid caps have grown slightly better, while small caps have actually declined over the last couple of quarters, right? So that's been the situation. But the second half, and especially the third quarter of this financial year, you will start to see earnings improving, albeit at a slower pace, I would say, and a gradual pace. We are likely to see maybe low double-digit kind of earnings growth for this quarter on a year-on-year basis, which is definitely a welcome positive change, I would say. As far as sequential numbers are concerned, yes, again, from a 4% growth, you are likely to see maybe close to double digits. So that's, again, an improvement that you will see.
Okay, fair point. That's a good assumption to make. Mr. Upadhyaya, we saw terrible pains in the rupee in the last quarter for calendar 2025. Now, some say it was RBI wanting to let it float and also reduce the impact of the additional 25% sanctions that we've seen in the US. What is the prognosis for our currency for 2026 at Kotak AMC?
Most of the volatility that we've seen in rupee dollar rate is probably behind us. It should settle at around current levels, although it will be very difficult to exactly pinpoint when that volatility is still in place, but our expectation is during this quarter we should see much less volatility on the currency, and it should stabilize at around current levels, in our opinion.
Okay, fair point. Now, how do you see, more importantly, the IT sector? This is traditionally, you know, been a very, very painful journey for the last 4 years, and especially for the last two, with the advent of the AI trade. Buybacks have happened. Stocks have moved up from 52-week, 4-year lows. Uh, is there hope that you hold out for retail investors as far as your IT picks are concerned? What would be your favorite hunting ground?
As far as IT sector is concerned, the business momentum still continues to be very, very modest. We really have not seen any change in terms of the commentary that's coming from most of the IT services or their users in terms of their likely discretionary spend in 2026, etc. So, to that extent, one cannot really pencil in a very strong earnings growth at this point of time for IT services sector. On top of that, there is also this question mark in terms of how disruptive AI is going to be for the regular IT services and what its impact on the business, on the earnings growth over the next few years. So, to that extent, it's very difficult to fundamentally make a case for a big valuation re-rating, and that to a sustainable one at this point of time. Having said that, I think the sector has underperformed in a big way over the last 18 months or so. So, to that extent, this sector being one where there is hardly any leverage, the cash flows are still very strong, while the growth is difficult to come by. But the rest of the parameters on the financial side are quite strong. So, to that extent, if the volatility in the market continues, probably this sector will still be relatively better off. However, at this point of time, we are not seeing it outperforming on a sustained basis over the next couple of years.
Okay, fair point. That more or less covers the broader market. A view that you would hold on bond yields. The reason why I ask is that mostly the rate cut cycle is at the last stage as far as RBI is concerned. Maybe half a percentage point we can expect in the first half of calendar 2026. What would be your view on bond yields, especially against the backdrop of rising global bond yields, especially in Japan?
I don't think there is a one-to-one correlation between what's happening in the global yields as compared to domestic yields, because if you look at the past 15 years, the kind of policies that most of the central banks have pursued has been very different than what has been pursued by Indian central bank. Right? Most people went in for easy money situation with lots of printing of paper, easy liquidity, etc., which our central bank has not done, and which has been very, very calibrated in its moves over the last several years. And that has helped us in terms of maintaining our inflation at a very moderate level. In fact, this is one of the multi-year lows that we are seeing as we speak. Right. So, given all of this, I think it's very unlikely that there will be a one-to-one correlation between what's happening in the globe and domestic yields. Having said that, as you rightly mentioned, we have seen probably most of the rate cycle playing out already. There can be one more rate cut at this point of time, or a longish pause. So, in any case, I don't think there is too much to expect in terms of further rate cuts. So, to that extent, the bond yields may remain in a range bound fashion, depending on the demand supply dynamics rather than the interest rate movements.
Okay, fair point. Mr. Upadhyaya, in terms of how we've seen a very sharp uptick coming in the financial services space for two reasons. One, borrowing costs were reduced. Two, you've had interest rate cuts, therefore loans and all have gone up dramatically. Because your parentage is from a very well established bank, how are you watching the banking BFSI space, so to say? Let's take I out, but banking and financial services. Is there some steam left beyond the surge that we've seen so far?
Definitely. We do have a very positive view on banking and financial services. We have already seen most of the rate cuts in this cycle, which means that whatever had to happen in terms of the compression of net interest margins is probably behind us, or probably there will be one more quarter of pain. But beyond that, I think it should stabilize. On the credit growth front, there is an expectation of an improved credit growth over the next a few quarters. And as far as the asset quality is concerned, by and large, the asset quality for the entire banking and financial services segment seems to be well in control. And valuations are not too high, although, yes, in the last quarter or so, some of the NBFCs have done exceedingly well. But still, I would say there is enough attractiveness in terms of the current valuations for the overall sector. There could be few stocks which are at higher level, but by and large, I think the sector is trading at a reasonable level of valuation. So given all of this, we do expect banking and financial services to outperform the benchmark over the next year.
Okay. Mr. Upadhyaya, how are you approaching 2026 as far as the defense space is concerned? Have valuations come down to levels that you feel comfortable with?
On a sectoral basis, I don't think the valuations have come down to attractive levels as far as defense is concerned. But clearly, this is a sector where medium to long-term growth runway is quite large, quite visible at this point of time. And there are companies which are likely to grow at reasonably high pace in terms of earnings growth as compared to the market. So as long as you pick some of those companies and don't overpay for those companies, you will still be making a reasonable amount. But I think you need to be a lot more selective in defense rather than going top-down basis.
Where are you still not hopeful for?
As I mentioned, IT services is something where we are still not very positive. I mean, we have not avoided it completely in the portfolio because that's something that we will not do in terms of diversification, in terms of the portfolio construction. But yes, I mean, on a relative basis, that is a segment where we are not very hopeful at this point.
Fair point. No issue. So, IT is something that you don't like. We've had a runaway rally in metals mainly because of the underlying trend in precious metals as also metals that are used for consumption. Is this a euphoric zone for them, or you feel comfortable with valuations in especially PSU metals?
As far as metals are concerned, they are currently being driven by a couple of factors. One, whenever you see dollar index losing value, you see metals moving up, and that's what is happening even now. There is also a possibility of anti-involution taking out some of the capacities from China, which has been a dominant producer for most of the metals. While the demand dynamics have not changed, the global growth continues to be muted. You are very unlikely to see a very large a positive change in demand side. It is likely that supply will be a little more constrained than what we have seen until now, and the dollar index is also losing its value. So some of these factors have led to hardening of metal prices. As far as Indian metal companies are concerned, clearly the amount of leverage that they had, let's say a decade earlier, was much higher than what it is today. So to that extent, from a balance sheet perspective, they are much more stable and healthy. And hence, in case of a rally, it will be a little more sustainable than what we have seen in the earlier cycles, I would say.
Okay, fair point. That's very well explained. Mr. Upadhyaya, how would you sort of now look at the pharma space? Where is value? There was a great CDMO trade that happened in 2024, 2025. Many of these stocks have hit fresh record highs and given stellar double-digit returns to sensible and long-term investors. How are you viewing the pharma cycle against Mr. Trump's insistence on tariffs from Indian exports?
As far as pharmaceutical exports are concerned, currently they have been left out of the tariff regime. There is zero tax on Indian exports to US. And we do believe that while there may be a lot of statements coming from the US on imposing tariffs even on this segment once in a while, we do not believe that they have alternate sources for getting those generic medicines, and which is also politically a difficult choice, right? I mean, you don't want your population to really see escalation in terms of the medical costs or the pharmaceutical costs. So to that extent, we do believe that while the noise may still remain, the earnings of the business is unlikely to get impacted as far as US exports is concerned. After having this view, our overall take on pharma is rather neutral, I would say. I mean, we would like to have US generic exporters as well as Indian pharmaceutical players, and also some of the other services like hospitals and diagnostics in our portfolio. And if you look across our portfolios, we do have quite a bit of diversified exposure within pharma sector in our portfolios.
Mr. Upadhyaya, very early, I'm talking about maybe 5 years ago, our common friend Mr. Shah was instrumental in picking up the chemical sector as a green shoot on the Indian economy, and that trade worked super well. But last 3 years have been very painful. I watch a lot of portfolios at Kotak. Some of the main frontline stocks continue to be in your portfolios, although their rankings in the top 15 have come down. What is the current investment thesis that is with you for the chemical space?
On the chemical side, we are quite positive on the speciality chemicals. As I had mentioned, for metals, there is an anti-involution trade that can happen even on the specialty chemical space, as some of the capacities from China are expected to go out of the market. The prices have started to harden after a period of inventory destocking, which had also led to underperformance of some of these stocks in the Indian market. We have seen that in inventory destocking happening, the prices moving up, the margins improving. So clearly things are improving for specialty chemicals, and we do believe that next couple of years are going to be better than what we have seen for, let's say, past 1.5 to 2 years.
Okay, fair point. On this very hopeful note, Mr. Upadhyaya, thank you so much for your time. And as always, the very best of returns are expected from 2026. And let's hope that Goddess Lakshmi is generous on us all more than what she was in 2025. Thank you for your time, and wishing everybody a great year ahead at Kotak Mahindra AMC. Thank you for your time, sir.
Thank you. Thank you.
That, ladies and gentlemen, is curtains for Market Guru as far as 2025 is concerned. It's been a great year for learnings, even though we may not have made as much money as we had thought in the beginning of 2025 that we would make. But hope is eternal, and we always wish for the very best. Here's wishing you a great evening as far as today is concerned, but a fabulous year ahead in 2026. Thank you for watching.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is BTS, that's Behind the Scenes, a show that shows a sneak peek into the latest edition of the Business Today magazine with all our viewers. Well, this time around, I'm joined by two of my colleagues, Surbi and Richa, who have done some exceptional stories in the latest edition. Remember, this is the copy that I already have my hands on to.